She's come last night, late last night from Delhi. She's here early morning, very committed. She's helped the BMPA out in the past too. She brings with her over 24 years of experience where she's pioneered research design geared to facilitate business decisions. She began her career in banking with ICICI in their planning and treasury department, and after completing a PhD in economics from the University of Mumbai. She's the chief economist at Yes Bank. As a thought leader, she has made extensive presentations on the Indian economy to state dignitaries of many international countries, councillors, ministers and secretaries of state in the UK and US. Her views are often aired in domestic and international electronic and print media, and we're extremely privileged to have this powerhouse of a speaker who has so kindly taken time out from her busy schedule. Dr. Shubhada Rao is going to speak to us about opportunity in adversity. Please give her a warm welcome, Dr. Shubhada Rao.
A very warm good afternoon to everyone. At the outset, I would like to sincerely, heartfelt thanks to the entire BMPA Summit Committee, whom I have been engaging with in terms of discussions for almost a year now. And I'm really delighted to be invited here to share some of our thoughts on what's happening across the globe in India. How do we strategize in such challenging times? From, of course, as typically said, an economist's perspective. I have been given a timer of, say, 30 minutes. It's very important for an economist because economists love talking. And till such time they have this strict monitor ticking in front of them, you know, it's a very easy risk that we run into, either getting the audience to sleep, to get them bored, or just feel happy that I've done a lot of talking. So I'll keep it short and brief. Over the next 15 to 20 minutes, I'm going to be talking on the subject that was earlier talked about, and we are going to take you through some of the basics. Why do we need to understand economics? Businesses are not carried out in vacuum. You need to monitor, you need to have a pulse on the overall economic environment. And since the time we have opened up our economy since early 90s, it's extremely pertinent that we know not just about what's going on in India, but more importantly, what's happening across the globe, because all of it does have its bearing on your business decisions, on your economic decisions. So, without much ado, I would like to start that yes, opportunity in adversity. We all know what the adverse conditions are today in terms of what is happening to global growth conditions, what's happening in India. But let me start with what's happening globally. We all know that there was a world pre-Lehman, there is a world post-Lehman. There are a lot of classical faiths that have been busted, that too big to fail, that the entrepreneurs, when they grow in size, make responsible economic decisions. More importantly, for the regulators, they cannot leave the entrepreneurs on their own. They need to be regulating, they need to monitor the risks, they need to know the origination of risk, distribution of risk. I think these are very difficult, expensive lessons that we have learned post-Lehman, and how we are trying to correct. Because what happens? We saw what happened post-Lehman. The economic growth across the globe collapsed, and an integrated world economic order, what happened in US and then subsequently what is happening in the Eurozone, is having a significant bearing on your growth prospects in the economy, in the Indian economy. So it's very important to learn the lessons from the adversity. But do we take adversity as a given and say that, okay, economy is not growing across the globe, not like 4 or 5%, we are going to make do with a 2 or 3% global growth over the next 3 or 4 or 5 years. Do I still sit pretty and take no dynamic decisions? Wrong. I think within the global economic order, the economies which were fairly insulated by their relative strengths in domestic regulated scenario, or central banks giving a more appropriate direction in terms of interest rates and so on, it is important that we identify as business decisions, to facilitate our business decisions, it's important to identify these pockets of growth. And that is what, to me, is opportunity in adversity. So while yes, US and Eurozone will take a while to get back to their trend record of growth of 4 to 5%, but what about the rest of the world? Agreed that they may not grow as strongly, but because they were well regulated, because they have domestic strengths in their economies, we still do see economies in Asia, India and China in particular. We see economies in Latin America. We see the BRICS. Of course, there is some slippage in the expected performance of the BRICS nation, Brazil, Russia, India, China, and Indonesia now. But the fact is, these economies are growing at 5% plus. We need to seek opportunities in this region. We need to seek, businesses in oil-producing economies. We need to seek businesses in the African region. These are the pockets of economic growth. So while there are adverse economic conditions prevailing, we do have opportunities. What about coming closer to home? We have seen that while yes, global factors did have a large role to play in decelerating what we saw in 2010-11 growth conditions. We grew back post-Lehman, we were at a growth of 6.7. We bounced back to 8.5% growth. And everyone thought that, oh, we are fairly insulated, our economic growth is not going to suffer, and therefore, it sort of led us to a certain degree of complacency. Did we adequately pay attention to some of the issues, burning issues like inflationary pressures, the widening imbalances on the government finances, or the widening imbalances on the external account of India, which is your balance of payment, what we typically read in the newspapers, current account deficit, and so on. I'll come to a basic structure of economic parameters that one needs to understand and what goes into those levels. But before that, I just wanted to identify that adverse conditions prevailed globally. Adverse conditions have erupted or resurfaced within India. We all talk of twin deficit problems. What are twin deficit problems? The fiscal deficit, that means the government is spending much more than its potential to earn through revenues, and as a result of excessive spending, we are borrowing. The government is borrowing much more from the market, and that has repercussion on interest rates. I'll come to that a little later. But even within the Indian economy, adverse conditions, be it, the ministers prefer to call a lull in economic policy. Actually, maybe somewhat it was policy paralysis. But do we still, therefore, take that overall India is a no-go now for the near term? We are still going to, struggle to grow beyond 6 to 7%? No. Even within the domestic economy, you will see, like the way I alluded to other regions across the world, within India also, we have pockets of growth. So let not the good growth stories, even within India, get completely ignored or disregarded, because India as a total economy has slipped in its growth from say 8.5–9% to about 5.5% region in the last few quarters. What are these regions that we are talking about? The regions which have been backed by good investment environment, good, relatively better discipline on government finances, more importantly, policy facilitation, be it making the land available or having some market efficiencies built into the distribution chain and so on. So these have been the states which have been successively over the last few years growing well above the national average of growth. Gujarat, Bihar, Chhattisgarh, Jharkhand, Goa, these have been the regions which have grown significantly in near double digits to double digits growth. So do we discard these good growth stories in India? Not really. We need to then segregate and identify opportunities in the overall adverse scenario. So the theme is basically how do we do best till such time that some of the economic challenges continue to prevail. And for that, I'm going to be an economist, I'm going to take you through some of the basic tenets that why we need to understand the economic environment. I think you all deal with the exchange rate issues, volatility in the currency. We all are grappling with the costs of borrowing, high costs of borrowing. All these are manifestation of everything that I spoke earlier, what's happening across the globe, what's happening within India, and therefore it's very important to understand what drives these levels. Coming to that, as everywhere, as in our domestic budget, you have a domestic budget, you have an external budget. Likewise for India. India has a domestic budget, that is the government's borrowing program, government's ability to earn revenue. With economic activity, as I said, at 5 to 5.5% growth, obviously your tax revenues are going to suffer. Your tax collections will not be as strong because your earnings are not so strong. So that has an impact on the government kitty, on the revenues. What is the repercussion? Also, the dividends may be turned lower by the government entities. What is the repercussion? The government has to therefore depend on non-tax revenue, and as a result, it is running around to find resources. So there comes 2G auction, 3G auction, spectrum auction. There comes the dilution of government-owned entities called disinvestment program. But even on the revenue side, the revenues are not enough, looking at the expenditures that the government is incurring. As long as the expenditures are productive, we are all fine. But where are the expenditures going? They are going into non-productive items like subsidies. Why are we talking of subsidies? Because they keep demand artificially high. If I need to pay a market rate on petroleum products, I must pay because that's the global level of the pricing of fuel. But if I keep it artificially low, I keep the demand artificially high. And that has been having a problem, a serious problem on the government finances, on the government expenditure, and we are running subsidy bills over 1 lakh crores. So that to me, or that to an economist, is a non-productive expenditure. True that you cannot do away with all subsidies. You need food subsidies because you have a population which is below poverty line. You need to subsidize food, or you need to subsidize some of the petroleum products for the needy, kerosene, LPG. But does it go to the targeted audience? Not really. There are leakages, and therefore government is now working on some ways and means to plug those leakages by a smarter way of distributing things, like a cash transfer of subsidy and so on and so forth. Coming back to the point, why therefore, if expenditures are running very high, what happens? The repercussion is on government borrowing. Government needs to borrow from the market. It then competes with the private sector entities. Now, if both are competing and if government deficit, fiscal deficit runs at a net basis to about 2 lakh crores, what happens? 2 or 3 lakh crores, what happens? It is pushing the interest rates higher. So when everyone is clamoring for fiscal deficit ratio to come down, fiscal deficit is your revenues minus your expenditure, and that gap on the negative side has to be bridged through borrowings. So very clearly, high fiscal deficit has a bearing on the cost of borrowing for the rest of the productive sectors of the economy, and therefore on interest rates, and we need to therefore, we keep harping on containing fiscal deficit or incurring of expenditure by the government on productive activities. If it spends on roads, ports, etc., you're creating productive capacities, you're creating efficiencies. That's why interest rates, fiscal deficits become extremely important. Coming to your external account, a very quick, within next 2-3 minutes, I'm going to give you a snapshot. At the end of the day, your currency levels are a reflection of the inflation differential. If my inflation in the economy is very high, obviously the cost of production is very high, export competitiveness gets eroded, and as a result of which, what happens? Your currency is therefore on a weakening trend. Why? Because other economies are doing well, or the faith in other economies' ability to bounce back is better, like what is happening in US, and therefore rupee continues to weaken because we are not able to create cost-effective production. And as a result, we do see currencies oscillating. Currencies also at the end of the day are supply-demand game. Okay, your demand for currency is high because our dependence on imports is high. Oil is one commodity that we import most. The non-oil or gold has also been a very high price of commodity that we have been paying for. But more importantly, if our domestic investments suffer, what happens? We import those non-oil, non-gold imports also, machinery, capital goods, because you know the domestic investment cycle is not picking up. So why procrastinate? What I need is in terms of machinery, 2-3 years later, when my Indian entrepreneurs of capital goods will start producing, I need to produce it, need it today, so I import it. So when the burden on imports goes up, what happens? The gap between the imports and exports increases. That is your current account gap. When your current account gap increases, say if I need about $30 billion of that gap to be bridged, I need capital flows of that account. Be it a foreign direct investment, foreign portfolio investment, external commercial borrowings, non-resident deposits, all these form the capital flows. If my economy is in an adverse economic kind of or adverse environment, capital flows will also not come in. Pressure will once again be on the rupee. That's what exactly happened. Over the year we saw, your current account. So twin deficits, one is your fiscal deficit, one is your current account deficit. Why is it? Because if we are a net importing economy, our dependence on capital flows makes us vulnerable. Because if there is global risk, capital flows will not come into India. They will put pressure on your currency, adverse, and we will carve out our needs to repay debt and to fund our imports out of our forex reserves, which once again has a negative sentiment on our currency. So it's very important to get our domestic macros well in order. Inflation has to be contained. How inflation can be contained? Your supply has to improve. Your demand, if it is excessively high, as I said for fuel, you need to contain your demand. So it's extremely important in the near term, when I look at high inflation, how do I manage? I need to become more productive. Productivity levels need to go up. My cost management has to improve. At least in the near term, this is what is in my capability, I will do it. What therefore is the next step is, if my domestic conditions still remain adverse, how do I set to improve? I need to look for opportunities for growth. Policies need to come on board. Land acquisition bill to facilitate investments, or you need labor laws to get it more flexible, or you need goods and services tax to get in uniform. So there are a lot of fiscal reforms needed. You need long-term investments for infrastructure. So you need pension and insurance bills to get cleared. So there are fantastic blueprints waiting in the economy. But even cyclically, we are seeing that perhaps this September and December quarter was the lowest point in the economic trough, and now we have been at Yes Bank monitoring the demand conditions index, and the sense we get is over the last 2 months, especially in the October-December quarter, we have seen an improvement in the consumption demand. It is gradual, it is going to be slow paced, but the fact is that the downtrend is over. What does it therefore have in future for us? In future, as we see confidence building up, if inflation pressures are easing, supplies are improving, inflationary pressures will ease, cost of borrowings will ease, and you may well know that anticipation from Reserve Bank of India of the next move is of a rate cut. Are we looking at a rate cut? Very clearly, yes. Why aren't we looking at a very high dose of rate cut? Because while the wholesale price indices may have declined over the last 2 or 3 months, the consumer price indices have not. The retail inflation still remains high, and as a regulator, as a central bank, monetary policy maker, although for businesses it would do wonderful to have 50 basis point cut by the Reserve, effected by the Reserve Bank of India on Jan 29, perhaps the economic conditions yet do not indicate that we are ready for 50 basis points because of the 10.5% inflation on consumers' prices. So that is the reason why overall inflation may have begun to ease on wholesale. It needs to translate into the retail inflation coming off, and what we are trying to look for is now how quickly we can come back to 8% growth. Are we likely to come back to 8% growth within a year? Perhaps not. It would be jumping the gun in terms of expectation. Because let's not forget, global growth is going to be only gradually improving. If you look at IMF projections released today, it's only 2014 that we could see some improvement in growth. But more importantly, domestically, we are into an election cycle in 2014. How strong is the will of the government to have on board bold reforms? Let's be realistic in our assumptions. Perhaps not very strong kind of a reform kind of agenda, but very importantly, the new finance minister or the reappointed finance minister is very clear on 2 counts. We just had meetings in Delhi yesterday. On 2 counts, they are very clear that they need to have fiscal discipline back on track. That is, government spending has to be qualitatively improving and also in quantum terms. And second, how do I recreate the investment environment back in India in over a period of 12 months or so? I think these are the 2 points that we picked up in Delhi yesterday. So opportunity in adversity is something that we cannot be sitting and twiddling our thumbs that yes, for next 3 years we are not, global economy is not going to grow at 4%, India is not going to go at 8%, but in the meantime, how do I internally improve my risk processes, how do I make it cost efficient, how do I raise my productivity levels, how do I seek out growth engines, growth pockets. I think if we pay adequate attention to all these 3 or 4 factors, I think we are going to minimize risks and we are going to maximize our opportunities. When the economy comes back to 8% plus potential and globe comes back to 4% growth, I think businesses will continue to grow the way they grew between 2004 to 2008. But till such time, we seek opportunities. You need to look forward. Now, if government has announced, investment regions through the DMIC corridor, what are the opportunities for you? There are 7 investment regions across India which are going to provide huge opportunities because new townships are going to be created, new facilities are going to come on board. So how does one identify these? Track these investment regions, seek out growth levers, seek out what are the government factors that are going to put growth back on track across the 8 states, across the 7 states and 8 investment regions. These are the opportunities for all of us to seek out. We at Yes Bank, we did that exactly. For us, the mantra was opportunity in adversity. So post-Lehman, we decided to consolidate. We decided to, cut back on risks. We did not understand then retail assets much, so we withdrew from the retail asset market. But we saw that there were pockets of growth available to us. We identified those opportunities. We grew, and today we are the 4th largest bank with a $15.5 billion balance sheet. And this has been the mantra for us, that seek out opportunity in adversity. And when opportunities rise, well, the party is on for everyone. But how do we separate the leaders from the laggards? The leaders are guys who look 6 months, 1 year ahead, both in terms of growth and growth in terms of what are the risks awaiting us. And be prepared to hedge your risks. For all of you, I think currency becomes an important ingredient. So you need to hedge your exposures, you need to minimize costs, become more efficient, become more productive, and I think the party can resume once again over the decade or 2, and India's growth story will continue to rock the world over 2050. Thank you.
Any questions for Dr. Rao? Yes, Bob.
Dr. Rao, there is a fiscal deficit and then there's a brittle deficit. Both borrow more than they can pay back quickly enough. My question to you is that, as an economist, can industries be differentiated based on the economy and the turnaround of every industry? Because when we approach a bank for any kind of borrowings, there is a standard format. So is there a possibility of a study where a printer is determined a little differently from other industries and probably a lesser rate of borrowing or something?
I need to add a caveat here that I'm the economist of the bank. I'm not a business decision maker of the bank. That's the basic caveat. But yes, I do agree that views matter. But unfortunately, not just my views, others' views also come on board. In this particular case, the Risk Management Committee has a lot of say in the business decision or the process in
Is
which...
there anything more risky than the government of India yet? We still support it.
I know, there's a classic case that we call it sovereign risk, which should be minimal, but globally we are seeing that those are the biggest risk originators, be it in US with the kind of deficits they run, or in Eurozone, we know what the sovereign balance sheet risks have been doing to the, the overall sentiment across the globe. But coming back to your question on a serious note, I think it's very important, yes, you need to understand the business. As a lender, I need to understand the business. I need to understand the model of that particular entity. How robust is the model? How he or she as an entrepreneur has, taken steps to hedge risks. Okay, if I'm lending to you, I would want to know what kind of FX exposure do you have? How well are you hedging it? Or in terms of backup plan, in case some of your planned expansion activities.
No, that's at an individual level. I'm looking at an industry level.
Is there
a special study on the industry per se?
As an industry, we go through differentiating between a cyclical phase of a problem or a structural phase of a problem. If it is cyclical, we would pay attention to how the businesses are minimizing the shocks of a downturn, because we know that they have a wherewithal to bounce back once the cycle gets into an upturn. But if there are structural problems, in the sense, if the entrepreneur doesn't understand the concept risk at all, okay, or he doesn't agree to prudent ways of expansion or prudent ways of conducting his business, those to us as lenders would be structural problems. So we would seek out, we would not perhaps, well, a few cases we would shun them away right away. But at Yes Bank, we have a knowledge banking approach. Our relationship managers at the bank have been the guys who belong to that sector in their earlier jobs or avatars. So they understand the business. They